Okay, let's unpack this. Imagine you're at the cusp of this massive celebration, right? The champagne popping, lights flashing, music absolutely blaring. But here's the kicker. The guest of honor, the one everyone's actually waiting for, well, they haven't even shown up yet.
Right.
And that's essentially the scene we're seeing unfold in the stock market right now. It's this huge party already in full swing, all anticipating something really profound that just hasn't quite happened.
It's pure euphoria out there, isn't it? Almost feels like this tidal wave of easy money has already been unleashed.
Exactly. But that's the core puzzle, isn't it? That's the paradox we need to get into today.
Yeah.
The stock market is absolutely soaring, hitting new highs, celebrating what it thinks is coming, this era of easy credit, widespread interest rate cuts. Yet the Federal Reserve, the actual body that holds the keys to those rate adjustments, they haven't actually lowered rates. Not a bit.
Not yet. Maybe not soon either.
In fact, yeah, if you look just ahead, there's a strong chance, an overwhelming probability they won't cut at their very next meeting.
Why?
It's just weeks away.
So why? Why is the market so incredibly optimistic, so convinced, when the facts, at least short-term, point to caution from the Fed?
It's a fascinating disconnect. And it's not just some market quirk, right? This is a really high-stakes economic drama playing out. Expectation, policy, politics, all colliding. And it directly impacts your wallet.
Yeah, what's truly fascinating here, and what makes this such a great topic for a deep dive, is that complex interplay. Market expectations, central bank policy, and, increasingly direct political influence. It's less like a simple economic equation and more like three-dimensional chess. Every move, every statement, every hint of a future decision sends ripples, real ripples, through the global economy.
Three-dimensional chess is a good way to put it.
So in this deep dive, our mission is really to pull apart the latest insights on these interest rate forecasts. We need to dissect Chairman Jay Powell's very deliberate and, often criticized wait-and-see approach. And contrast that with President Trump's view.
Exactly. And President Trump's strikingly different perspective that call for immediate, aggressive cuts, including his very public, frankly, unprecedented plans for who leads the Fed next. And if we connect this back to you, the listener, this isn't just abstract theory. It's not just numbers economists argue about.
Right.
This deep dive is fundamentally about understanding those powerful forces, often unseen, that directly impact your car loan, your credit card rates, maybe your mortgage payment, your investments, your purchasing power, the whole strength and direction of the economy you're navigating every day. We want to explore the why behind these decisions, these expectations, and what it could all mean for your financial future. Help you cut through the noise, really.
Okay, so let's start with that market euphoria. What's really fueling this? You look at the headlines, maybe glance at your 401k statement, and it feels like a celebration.
Definitely feels that way. The market isn't just, cautiously optimistic. It's euphoric. Brimming with this belief that a flood of easy money isn't just possible, it's inevitable, right around the corner.
And easy money. Just to be clear, we're talking low interest rates, readily available credit, generally great for stocks.
Generally great, yeah. For a few key reasons.
Yes.
Right. First, it lowers borrowing costs for companies, makes it cheaper to invest, expand, innovate, even buy other companies.
Think R&D for a tech startup or a new factory for a manufacturer. Cheaper loans mean potentially higher returns, better profits.
Which makes their stock look more attractive. Second, lower rates make stocks look better compared to bonds.
Right.
Bond yields are low, so investors look for higher returns elsewhere, like the stock market. Drives up demand.
And third,
For individuals, cheaper credit fuels spending.
Yeah.
Lower rates on car loans, personal loans, even credit card balances. It frees up disposable income. People buy more stuff.
which boosts the economy, helps businesses, and loops back to their stock prices. A virtuous cycle, potentially.
So the market is basically betting the farm that the Fed starts cutting rates very soon, like in about 2.5 months. This expected loosening, this easy money narrative, that's what's driving the optimism.
The market is forward-looking, pricing that future in now.
Exactly. The future looks bright in the market's eyes.
And we can actually quantify that expectation, you know? It's not just sentiment. We can look at tools like the CME FedWatch data.
The FedWatch tool. Yeah, explain that a bit.
It's basically a window into the market's collective bet. It tracks the probabilities of future Fed actions based on how Fed funds futures contracts are priced. It's what the big money is betting on.
So what's it saying right now?
Okay, let's look at the immediate future first. The Fed's last meeting was June 18th. No cut then, as expected. Their next big one is July 30th, just about a moment away.
Right.
Now, despite all this market euphoria about future cuts, the odds for a cut at this specific July meeting surprisingly low.
How low?
The tool shows a high 77.3% chance that the Fed will not cut rates in July.
Wow, over 77% chance of no cut. That seems like a real contrast to the general mood.
It is, and it's a crucial point of intrigue. Why so low for July when the market feels so bullish overall? It really comes back to Powell's consistent message, that wait-and-see stance he keeps emphasizing.
Which he just reaffirmed at that congressional hearing, right? We'll get into that.
Exactly. So for July, the market seems to be actually listening to Powell, taking him at his word for now.
Okay, but what about after July?
Well, that's where the picture shifts dramatically. It shows how forward-looking the market is. The overwhelming bet is that the Fed starts cutting rates at their September 17th meeting.
Overwhelming how? Like, what are the odds?
The confidence is huge. There's a staggering 92.1% chance priced in for a cut by that September meeting.
92%.
Okay.
So September is the magic date in the market's mind.
It seems so, and it's not seen as just a one-off thing, a single small cut. It's projected to be just the start of a whole easing cycle, a sequence of cuts beginning then.
And does the Fed's own forecast line up with that?
Well, if you look at the Fed's dot plot, those individual forecasts from Fed officials, they've broadly indicated they expect maybe 2 interest rate cuts in 2025.
2 cuts next year.
Right. So if the first one happens in September, the market expects another one fairly soon after. Maybe later this year, maybe early next.
Got it. So it's not just one cut. It's the start of a sustained period of easier money flowing into the system. That's the excitement.
That's the anticipation fueling asset prices right now.
So what does this all mean for you, the listener? Beyond just these percentages and probabilities, this huge market optimism pinned on September, it translates into this idea of easier monetary policy, and that has real, tangible impacts.
Like we said, lower rates, cheaper borrowing.
Think about it practically. A small business owner wants to expand. Maybe they can get a loan for new equipment at a lower cost. Helps their bottom line, helps them grow, maybe hire people.
And for you, personally.
Could mean lower interest rates on really important stuff. Need a new car. Your monthly payment might be lower. Carry a credit card balance. Well, variable rates might feel some downward pressure.
Mortgages too, right? That's the big one for many.
Absolutely. Lower rates could mean lower mortgage payments. For someone buying a home, it might be the difference between affording it or not, or just saving a chunk of money each month.
Or refinancing opportunities for current homeowners, freeing up cash flow.
Right. And because the market looks ahead, it's pricing these benefits in now. That's the celebration we're seeing in stocks, even before the Fed acts. It's like investors have already popped the champagne based on an invitation. There sure is coming.
Yeah, the invite's in the mail, they think.
So understanding how these expectations are already influencing asset prices, stocks, bonds, maybe even real estate, it's crucial for thinking about your own investments, your savings, your planning for the next few years. It's about being informed, not just getting swept up.
Okay, so let's pivot now. From the market's eagerness to the man right at the center of the immediate decision. Fed Chair Jay Powell.
Right. Mr. Wait and See.
Exactly. Despite the market's clear bets, despite maybe pressure from different corners, Powell is sticking to this deliberate wait-and-see approach. He is, by all accounts, in absolutely no rush to cut rates.
And why not? What's the core reason?
The core reason, and this is apparently the shared view among all professional forecasters inside and outside the Fed, is this strong belief that inflation will rise meaningfully in the second half of 2025.
Rise meaningfully, not just a little bump.
Precisely. That's the key word. This isn't a minor worry. It's the central pillar of his strategy. His reluctance stems from that future risk. He's prioritizing the long-term inflation fight.
Okay, but why do they expect inflation to pick up again? Haven't the recent numbers been a bit better?
They have shown some moderation, yes. But Powell's been specific about the future risk. He's pinpointed the uncertainty about the size and potential persistence of the potential but highly uncertain inflation from tariffs.
The tariffs again. Okay, explain that link. How do tariffs cause inflation, and why is the uncertainty the key factor for the Fed?
Sure. Tariffs are basically taxes on imported goods. When you tax imports, they immediately become more expensive for buyers here.
Right, so the cost gets passed on.
Typically, yes, to consumers, usually. So a tariff on imported steel makes cars, washing machines, anything using that steel more expensive. Tariff on clothes. your shirt costs more. Simple as that.
And it doesn't stop there, does it?
No, there are cascading effects. If a U.S. company uses imported parts, tariffs raise their production costs, which they then pass on. And importantly, domestic producers facing less competition from cheaper imports might also raise their prices. Because, well, they can. Fewer cheap alternatives for consumers.
Okay, so it creates broad upward pressure on prices.
Significant upward pressure. Now, the uncertainty Powell talks about is crucial. The Fed needs to figure out not just if tariffs will cause inflation, but how much and for how long.
Is it temporary or will it stick around?
Exactly. Will it be a short-term blip? Or will it get embedded in prices? They can't really know until the policies are actually in place and the effects show up in the data.
So they need to see the whites of its eyes, so to speak.
Pretty much. This unpredictability is why Powell feels he has to wait. He wants decisions based on clear, observed data, not potentially wrong forecasts.
Because cutting rates now, only to have tariff inflation surge and force them to hike again, that would be bad.
Much worse. Bad for the economy, bad for the Fed's credibility. He wants to avoid that whipsaw at all costs.
That uncertainty really came through at that congressional hearing, didn't it? Where Powell got grilled about high rates hurting America.
Oh, absolutely. That was a very public display of the tension. Lawmakers were pressing him hard, pointing out the real-world impact.
Yeah, things like car loans, credit cards, mortgages, stuff that affects everyone. When rates are high, borrowing costs more. Period.
We even heard reports that the FHA director, PAY, was asking for lower rates because of the impact on home buyers.
The FHA, yeah, helping first-time buyers, lower-income folks. High rates can just price people right out of the housing market. It's a huge affordability issue.
Definitely. And Powell also faced that other question. Why are U.S. rates so much higher than elsewhere?
Right, the global comparison.
Yeah.
Where are we versus others again?
Well, the U.S. rate set by the Fed is 4.5%. Compare that to the U.K. at 4.25%, China 3.1%, the Eurozone just 2.0%, Japan 0.5%, and Switzerland almost zero at 0.25%.
Wow. So the U.S. is really an outlier on the high side there.
Significantly higher than many peers. It highlights just how different the Fed's position is right now.
So faced with that, and the pain points here at home, how did Powell respond? Did he budge?
He acknowledged the argument. He basically said, look, if you just look in the rearview mirror and look at the existing data, yeah, you could make a strong case for cuts, maybe even imply we should be at a neutral level, which could mean a couple of cuts.
There's always a but.
But he immediately pivoted back to the future forecasts, especially the inflation risk from tariffs. He explicitly said they need to wait until we see what the policies are. That tariff uncertainty is the big roadblock, overriding what the current data might suggest alone.
So he's really prioritizing that price stability, part of the Fed's dual mandate, over, say, maximizing employment right now.
It certainly seems that way. He's leaning heavily on fighting potential future inflation, accepting the current higher borrowing costs as the price for that, to prevent a potentially worse surge later.
It's a conscious choice, a trade-off.
Definitely. Which brings up the question, given how firm he is there any chance of a July cut? Some Fed members hinted it could be possible if inflation stayed low.
Like Bowman and Waller.
Right. But Powell's own message at the hearing was just crystal clear, repeated multiple times. There's no rush to cut interest rates.
No rush. Why? What's his justification for patience?
His main points were that the economy is still strong, and crucially, the labor market is strong. GDP growth is steady, unemployment low, job creation consistent. That underlying strength gives the Fed breathing room.
Breathing room to wait and see on inflation and tariffs?
Yeah, exactly. He did say a weakening labor market would matter for that decision. So if we saw significant job losses, rising unemployment, that would be a trigger for cuts.
But without that trigger.
But without that, the current strength allows for patience. They can monitor things carefully.
Which really highlights that fundamental trade-off, doesn't it? Supporting the economy now versus preventing inflation later.
It's the classic central banker's dilemma. Lower rates now would boost activity, help borrowers, maybe stimulate investment. But Powell's betting that waiting, even if it causes some friction now, is better than cutting too soon, letting inflation reignite from tariffs, and then having to slam on the brakes even harder later.
That could cause a recession, right? If they have to hike aggressively later.
That's the fear. A policy reversal like that can be highly disruptive, kill confidence, lead to a worse downturn. So Powell's strategy prioritizes long-term price stability. Keep the value of your money steady.
Even if it means higher mortgage payments and car loans for a while longer.
That's the trade-off being made. Securing the gains against inflation, aiming for a stable foundation, even at the cost of some immediate economic friction. It's a delicate balance, and he's clearly weighting the scales towards avoiding that inflation comeback.
Okay, and this is where the whole thing gets even more interesting, maybe more complicated, because we pivot from Powell's cautious economics to some pretty direct politics,
Right. Enter President Trump's perspective.
which is, well, the complete opposite of Powell's, basically.
Yeah.
Contrasting sharply with that measured, data-dependent wait-and-see approach, Trump's call is aggressive and immediate.
Couldn't be more different.
Trump's core argument, stated very clearly, is rates should be cut right now.
Yeah.
No delay, no waiting, no seeing, just cut. He sees Powell's caution as a big mistake.
And he backs that up with a very specific financial argument, especially looking at it from the government's point of view.
What's the argument?
He argues lower rates would save the federal government a ton of money. Hundreds of billions of dollars in interest expense.
Hundreds of billions.
Well, the source material gives a specific example. It suggests a 3-point drop in rates could save about $900 billion a year on the national debt interest payments.
Wow. $900 billion a year. That's a massive number.
It's huge. Interest on the debt is already a huge budget item, heading towards $1 trillion a year and growing. So every little bit rates go down saves the government enormous amounts of money.
Money that could be used elsewhere or just reduce the deficit.
Exactly. Lower rates mean the government pays less to borrow. That frees up potentially hundreds of billions. It's a very concrete financial benefit, and that's a key part of Trump's argument. He frames it as fiscal common sense.
Okay, so save the government money. But what about the inflation risk that Powell is so worried about? How does Trump address that?
Well, this is where their philosophies really diverge. Trump seems to have more of a, let's call it a deal with it later strategy regarding inflation.
Deal with it later.
His argument, essentially, is that if inflation does pick up again in the future, maybe a year, 2, 3 years down the road, well, the Fed can always raise interest rates, then to fight it.
So cross that bridge if and when we come to it.
Seems to be the implication. It shows a fundamentally different risk tolerance. Powell wants to prevent the fire. Trump seems willing to risk the fire starting, believing they can put it out later if needed.
Prioritizing immediate stimulus and government savings over potential future inflation.
That appears to be the calculation. Get the immediate benefits now, worry about the potential downside later.
But surely that deal with it later approach has its own big risks, right?
Mm-hmm.
Isn't inflation harder to stop once it gets going?
Oh, absolutely. Huge risks. The danger is that inflation, once it really takes hold and gets embedded in expectations like wage price spirals, can be incredibly difficult and painful to root out.
Like trying to stop a speeding train versus slowing it down early.
Good analogy. If inflation gets entrenched, the Fed might have to hike rates much more aggressively for much longer, potentially causing a deeper recession and more job losses than if they'd acted preemptively. It's reactive versus proactive.
And entrenched inflation just eats away at everyone's purchasing power day after day.
Exactly. Makes everything more expensive. So it's a very different assessment of risk and priority compared to Powell's approach.
And the differences aren't just about policy, are they? Trump has been personally critical of Powell.
Yes, and it's important we report this impartially, just stating what the source material says Trump has expressed. He's reportedly described Powell as an average mentally person, suggested he has a low IQ for what he does, and even called him a very stupid person.
Wow. Strong words.
Very strong. And Trump has also suggested Powell is probably a very political guy.
Which is ironic given the Fed is supposed to be independent from politics.
Precisely. And that raises a really important question. How do these kinds of intensely personal criticisms, coming from a major political figure like a former president, potentially impact the perceived independence of the Fed?
Yeah. Does it undermine their credibility?
It certainly can. That independence is seen as crucial for the Fed to make tough calls without political interference. When the chair faces direct personal attacks like that, it can erode public trust, create market uncertainty, and maybe even implicitly pressure their decisions. It definitely creates a very fraught dynamic.
Okay, so this intense difference in views and the personal criticism, it all leads directly into what sounds like a looming battle, right? The succession question.
Absolutely. Who leads the Fed next? This is potentially huge, shaping interest rates and the economy for years. We're shifting now into that political dimension. President Trump is reportedly already thinking about who he'd nominate to replace Powell.
Even though Powell still has time left on his term. How much?
Powell still has 11 months left, so nearly a year. But the talk about his successor is starting early.
And is that unusual? to start planning the replacement so far in advance?
The timing Trump is reportedly considering is unusual. Normally, presidents nominate a new Fed chair maybe 3 months before the term is up. So that would be around February next year in this case. Gives time for confirmation hearings, a smooth transition, minimizes disruption.
But Trump plans to announce much earlier.
That's what the source indicates, much earlier. And the strategic goal seems pretty clear: to influence the markets and essentially make Jay Powell a lame duck for the rest of his term.
A lame duck, meaning his power phase because everyone knows he's on his way out and who's coming next.
Exactly. Trump wants to shift market focus and expectations immediately away from Powell and onto his own pick.
Can you give an example of how that would work? How an early nomination influences things?
Yeah, the source gives a vivid scenario. Imagine Powell comes out later this year and says, look, we're not cutting rates for 2 years. Inflation risks are too high. Normally, markets would react to that, right? Price and higher rate.
Sure. Bond yields might rise, stocks might dip.
Okay, but now imagine Trump, maybe even today, nominates someone, let's use the source's hypothetical name, Scott Bent. And Bent immediately goes public saying, when I take over next May, I'm doing massive interest rate cuts.
Ah, so you have conflicting signals. The current chair saying one thing, the nominated successor saying the opposite.
Right. And in that scenario, the source suggests the market would likely ignore what Powell says for the rest of his term. Why? Because the future direction is already signaled by the incoming chair.
Ben would effectively be backseat driving Fed policy before he even gets the keys.
Exactly. Investors, traders, businesses would start making decisions based on Ben's promise of future cuts. Bond yields might fall, stocks might rally now based on that expectation. It's a way to inject Trump's desired policy into market expectations immediately, trying to bypass Powell's current authority.
That's quite a strategic play. And what kind of person is Trump looking for? What's the criteria?
Well, according to the source, the intention is very direct. He's looking for someone loyal to Trump who will specifically do his bidding of deep interest rate cuts.
His bidding. So not just someone whose economic philosophy aligns, but someone who will follow orders.
That's the implication. The source even explicitly mentions the idea of an under-the-table deal. The understanding being, I'll nominate you if you're going to do what I say.
Wow. That really goes to the heart of Fed independence, doesn't it?
It absolutely does, and that's a major point of concern for many economists. Fed independence is considered a cornerstone of economic stability. It allows them to make tough calls based on economics, not politics.
Because if the Fed just does what politicians want,
history shows that can lead to trouble. Runaway inflation, instability, loss of confidence. When central banks lose independence, it often ends badly.
So a nomination based on explicit loyalty, on doing the president's bidding, could fundamentally change how the Fed is perceived and how it operates.
It could seriously erode trust, introduce volatility, and impact the credibility of the whole U.S. economy globally. It raises really profound questions about checks and balances.
Okay, so we've covered the market's optimism, Powell's caution, Trump's aggressive stance, and his plans for the Fed leadership. Let's bring this all back home. Let's circle back to the stock market hitting these record highs.
Right. Let's challenge some assumptions about why it's so high.
Is it because the underlying economy is just firing on all cylinders, everything booming, profits exploding?
Or is it because the labor market is just incredibly strong? Jobs everywhere, wages soaring, signaling huge consumer confidence.
According to the source material we've been digging into, the answer to both is basically no.
That's right. The market's current strength isn't primarily a reflection of amazing organic economic strength, nor is it driven by an exceptionally fantastic labor market. Yes, they're okay, they're functioning, but they aren't the main engine of this rally.
That's a really important distinction. Cuts through a lot of the noise. So if it's not the fundamentals of the economy or the labor market, what is the single biggest driver?
The answer, according to our sources, is actually pretty straightforward, almost simple, but incredibly powerful. It's simply an easier monetary environment.
Easier monetary environment. Okay, break that down. What does that mean in practice?
It boils down to two key things we've touched on. First, that deeply embedded expectation, almost a certainty in the market's view that the Fed is going to cut interest rates soon. Like we said, probably starting in September.
The market isn't waiting for the cuts, it's trading on the anticipation of them.
Precisely. Pricing in future benefits now. And the second key component, maybe less talked about but hugely important, is the fact that the M2 money supply is at new record highs.
M2 money supply. Remind us what that is.
Sure. M2 is a broad measure of money circulating in the economy. Think cash in your wallet, money in checking and savings accounts, money market accounts, some mutual funds, basically readily available liquid money.
Okay. And that's at record highs.
New record highs, which means there's just an unprecedented amount of liquid cash sloshing around the financial system.
And where does all that cash go?
Well, with interest rates on safer things, like savings accounts still relatively low, a lot of that money seeks higher returns. It flows into financial assets, especially stocks.
It's like too much money chasing the available assets, pushing prices up.
Exactly. It's a classic asset price inflation scenario. Lots of liquidity floods the system. Investors move into equities looking for returns, driving up demand and prices.
Mhm.
Corporations also tap into this liquidity for things like stock buybacks, which also boosts share prices.
So the bottom line is pretty stark then.
The source puts it very clearly. It's just easy money. That's what's driving the stock market higher. That's all.
That's all. Wow. So for you, the listener, understanding this is crucial, right? Knowing it's more about monetary policy expectations and sheer money supply than a booming underlying economy.
Absolutely. It helps you cut through the headlines, understand the real forces at play. It allows for more informed decisions about your own investments, your savings, your financial strategy. You see the levers being pulled, not just the surface results.
It gives you a clearer perspective, helps you approach your financial future with more discernment. Okay, so let's try and wrap this up. We've really unpacked quite a fascinating and maybe worrying tug of war here.
Definitely a complex picture.
On one side, you've got the stock market almost giddy with expectation, celebrating future rate cuts, looking hard at September. On the other, you have the Fed, Jay Powell, being very cautious, worried about future inflation, especially from tariffs, holding rates steady for now.
Wait and see.
And then crashing into that, you have President Trump demanding immediate cuts, citing massive debt savings, and planning this very political move regarding the next Fed chair to try and force the issue.
Expectation, policy, politics, all tangled up.
Yeah. And if we connect this to the bigger picture, like you said earlier, it really highlights that fundamental tension, doesn't it? Between central bank independence, letting the Fed make decisions based on economics alone, and the very real pressures from political leaders who have their own agendas and timelines.
It's a critical dynamic for any modern economy. This isn't just abstract finance theory. It's about how economic power is structured and wielded.
Which leaves us, and you, the listener, with a pretty profound question to think about, doesn't it?
I think so. In a world where monetary policy, Fed decisions, and political influence all hit your wallet so directly, your mortgage, your investments, your job prospects, how do you personally weigh these competing arguments? How do you balance the argument for long-term economic stability, the kind a cautious, independent central bank aims for, against the argument for immediate economic stimulus, lower borrowing costs now, which is often what political pressure pushes for?
Stability versus stimulus, long-term versus short-term.
Yeah. Consider how these fundamentally different philosophies might shape the economy you live in. Not just for the next few months, not just until the election, but for years, maybe decades to come. How might it impact inflation, growth, financial stability, long after we know who the next Fed chair is?
It's a question about the very foundations of economic governance and its lasting impact on all our lives. Definitely something to mull over.